While many commodities had a strong run in 2025, our featured guest today says simple supply and demand dynamics could push prices even higher in 2026. Hussein Aladina, Managing Director and Head of Commodities with TD Asset Management, joins us now with more. Hussein, great to see you. Okay, we all know about the year behind us and how strong it was. Let's talk about the conditions right now and why you still see them as positive for commodities.
Thanks, Greg. And sorry, I'm not in the studio with you today. It's very much the story about where we are in the commodity cycle. 12 to 13 years, the commodity space has not attracted capital into the supply side, frankly, and that has contributed to sort of limiting our ability to produce. And demand is growing. And in 2026, with the reflation trade very much in focus, demand looks like it's going to continue to grow, and that continues to tighten balances and support prices. Ultimately, we need to see prices move to levels that encourage the companies to deploy capital. And because commodity supply is inelastic, it's going to take years before that copper production, that oil production comes to market.
I know depending on the commodity, we'll have a different story about what the demand is. But overall, we're talking about a stronger global economy. We thought new technologies, a bit of hedging. What's at play here?
Yeah, so the biggest driver of commodity demand, broadly speaking, is economic growth. And with this material focus on ensuring that economic growth, not just in the US, but globally, is increasing to make sort of the debt and deficit relative to GDP improve, there's a pronounced focus from both a monetary and a fiscal impulse perspective to drive growth higher. So that's kind of the big thematic. But if we look sort of under the hood, clearly the desire to build out hyperscalers, data centers, and the required power generation is going to be very constructive for commodities, broadly speaking. And the spend on military and defense is very commodity intensive. So I'd argue that your GDP being positive is the biggest driver, and then kind of in the details, there's very specific things that are going to require a tremendous amount of copper, uranium, natural gas, as we kind of move into this new world.
All right, let's get into those specific things. You mentioned copper. Let's talk about the bullish case for copper.
Yeah, so copper has moved pretty meaningfully. We're trading north of 13,000 a ton in the LME. Part of this is a reflection of concerns around sort of Section 232 and kind of the magnitude of tariffs, if at all, that we'll see on copper, aluminum, silver, and other sort of strategic materials. That's contributed to bringing supply or sucking supply from the rest of the world into the US. There was some news overnight on Section 232. It doesn't look like a tremendous amount of clarity. But outside of that, Greg, again, GDP growth is very, very supportive for copper demand. And the AI sort of energy transition theme requires quite a bit of copper, right? These hyperscalers, data centers have copper within them. The power that is going to be used to facilitate the sort of growth in data centers requires a tremendous amount of copper. We're seeing aluminum perform as well because there is some industrial substitution that happens as copper prices move higher. But that's kind of the big story on the demand side. And then on the supply side, we have seen in 2025 a number of mines disappoint. And again, because we've not encouraged CapEx over the course of the last 10 years, when we look at that pipeline, in the next 3, 5, 7 years, there's no new major, copper projects that are coming to market. And that ultimately, I think, is what lends to this view that the copper market on a multi-year view is going to be in deficit.
All right, that's copper. Let's talk about gold and silver. Gold's been very interesting for a long time, but silver in the last several months too, catching a lot of attention. What's the story here? What's the setup?
Yeah, so I'll talk to gold first, right? And the gold story is very much sort of portfolio diversification on the part of central banks. If we look at emerging market central banks, they have been large buyers of gold, broadly speaking, since 2021, following the confiscation of Afghan and then following that, Russian reserves by the US government. If you are an emerging market central bank sitting on 80, 90% of your reserves in fiat in paper, I think there is some desire to diversify into gold, and we're seeing that. Those emerging market central banks have been buying over 1,000 tons of gold per annum. For perspective, Greg, we produce about 2,500 tons of gold annually. So that's been a big source of demand, and we don't think that changes anytime in the near future. And then you have obviously seen some interest on the part of institutional and retail to participate in gold. And you can see that by looking at the amount of open interest that sits in the ETFs that track gold. Those ETFs are still well below, from a open interest perspective, well below the highs that we've seen in recent years. So there is still, I think, some additional fodder there. Silver, a very different story. Silver, is not being bought by central banks. It is being bought by investors for sure. There's a larger industrial component to silver, but if I look at the balance, the silver balance, it's in deficit. And I'm going to sound like a broken record, but I've not encouraged the production of silver. If we look at the largest producer of silver in the world, Mexico, their production is declining. And it's going to take time for us to grow supply in a meaningful way. Now, I just want to caution, right? Silver is something that has moved meaningfully over the course of the last 6 to 12 months, and in particular over the course of the last 6 to 8 weeks. We could see silver up another 20%, down another 20%. It's not something that we are actively participating in our fund.
Okay, let's talk about oil, because obviously we're seeing some whipsaw action from day to day based on geopolitical tensions. Today we're down almost 5% on a barrel of crude. How does an investor start to think about crude in this environment?
Yeah, so we can address it in two parts, right? There's the fundamental supply demand balance, and concurrently, we've got sort of the geopolitical supply side risk. Fundamentally, balances should be on paper oversupplied through 2026 in the tune of somewhere between 1 and 2 million barrels a day. This is something the market has been anticipating for a very long time. Admittedly, the builds and inventories that we have seen globally have not occurred in commercial centers. So you're not seeing it in the Department of Energy data in the US, you're not seeing it in the ARA data out of Europe. You are seeing material builds and inventories, but those inventories are being held by China. It's gone into the Chinese SPR, and they do have room to continue to build, so that should they, pardon me, choose to do so. We're also seeing a lot of oil sitting on water. This is part of the, I guess, reflection of the sanctions. Oil has been stranded, particularly in the Far East. So you're seeing more oil sitting on water. Ultimately, that should come to market, but it's unclear if China again continues to buy, given kind of the geopolitical landscape. We've seen Venezuela sort of disappear very much as a source for China. Now, on the geopolitical front, and the reason that crude is rallying and has been rallying over the course of the last week is right around this situation in Iran, which is a horrible situation. Fourth largest producer of oil globally. They produce 3 million barrels a day. They export 1 million barrels a day. Unclear how that situation evolves, but the market is pricing in some risk around a supply disruption. Greg, we've talked about this before. Over the course of the last 10, 12 years, we've not had any meaningful supply side disruption around geopolitics. So I think the market's a bit benign on this, notwithstanding the fact that prices have increased. If there were to be a disruption, price would be materially higher than where it is today.
You put all that together from an investor perspective. Commodities have been grabbing a lot of headlines. What kind of role can they play in a portfolio?
Yeah, so we've argued for a while. Academics and those that are kind of students of portfolio construction will tell you that because commodities, the derivative, behaves differently than the stuff that we hold in our portfolio today, equities, fixed income, you want an allocation of 5 to 10% because it's diversifying, because it is one of the few assets that is positively correlated with inflation, so it acts as an inflation hedge. And then sort of on top of all that, Greg, given that the commodity space has not seen investment over the course of the last 10 to 15 years, we're in a very unique period for the commodity market where prices will have to move higher in an effort to attract capital. And again, we're competing today with AI that's taking a lot of that capital. AI itself is very commodity intensive. For the next 5, 7 years, we do see commodity returns averaging well above their long-term average of 5.4%. And we think that portfolios that have this sort of 5 to 10% allocation to commodities will not only outperform those that don't, but the drawdown historically of a portfolio that has commodities is shallower than the portfolio that doesn't.